Today. I don't have a class after you today because that previous trading class ended last week. So we could possibly have a little bit more time to go through some questions and answers and maybe look at some real-time charts and give you a feel for what it's like to actually do wave analysis in real time, which is what some of you have decided to do with Magellan by signing up for the more advanced class, which is a real-time applications class. So let's get on with chapter 11, and there's about 5 or 6 emails we can get to, and then move on to maybe some real-time analysis. The point in the book when you get to chapter 11 is really to fine-tune the structure of a pattern. So if you think you have a flat and it appears to follow the basic rules, and possibly it started confirmation or it's already created confirmation, chapter 11 gives you some rules about how it might look, how it might behave before and after, position that pattern might exist in, just a lot of little details that help to fine tune and your count and increase your confidence in the scenario. So a lot of this is more like reading a dictionary or an encyclopedia than it is something you could learn by reading the whole section. It's more of like reference. You have an impulsive pattern and it's trending. Well, then you would go to chapter 11 and you would go to the impulse section and the trending section, and then it breaks it down from there into specific categories. So it'll give you the description of what a first wave extension might look like, what kind of relationships you might have between the patterns, possibly how it might channel and so forth. Like for example, if the first wave is going to be the extended wave, the odds are pretty high that wave 2 won't retrace more than 38%, because the bigger wave 2 gets, the more difficult it's going to be for wave 3 to make a new high and for wave 4 not to overlap the top of wave 1. So that's the reason why wave 2 needs to be shown if the first wave is going to be the extended wave. By the way, I keep hearing these beeping sounds in the background. I'm not sure if something is wrong or not. Normally that sound occurs when people can't hear me. So can somebody let me know that you hear me in the question and answer section and that everything is going fine? Because I'm a little worried about that sound I keep hearing in the background. I don't say anything. Somebody please tell me if you can or cannot hear me. Looks to me like the system is working. Yeah, you can. Okay, good. Okay. So when you get a first wave extension, it's important that wave 2 is not very deep, because you're going to have problems with wave 3 making new highs and wave 4 not overlapping, and then wave 5 making a new high beyond that. So this is where you would actually go to do the specific testing of a pattern that you think is a first wave extension impulsive pattern. And if the first wave didn't extend, then it goes through what might happen. Now I want to fine tune some of the stuff that's in the book here. For those of you who hopefully have a copy of the book, I'm going to want you to, maybe with a pencil, change some markings here. It would be extremely, extremely unlikely that any part of wave 2 would retrace 99% of wave 1, no matter what kind of impulsive pattern you're in, because that's not the way reactions occur after an impulsive move. I've seen it maybe once in 40 years, so you should just assume it doesn't happen. So 61% perfectly acceptable, maybe 70 on rare occasion. Getting much beyond that, it starts to become very improbable that you're dealing with a wave 1 advance of a 5-wave move. If the 2 wave does initially retrace more than 61% of wave 1, it's very important that when it concludes, that it concludes at 61% or less, so that the launching point has enough strength to start the 3rd wave, which then has to be longer than wave 1 if wave 1 is not the longest. So I think it mentions that in this section, but you don't want to allow wave 2 to be too deep unless you're in a terminal pattern. In a terminal, wave 2 can be 99% of wave 1, wave 4 could be 99% of wave 3. That's the only time you would ever really see that happen. And looking back on the scenario that I'm thinking about, when I did see what appeared to be a 99% retracement of wave 1 by wave 2, that was probably 20 something, maybe even 30 years ago, when I knew way less than I know now. So there's a chance it wasn't even a properly analyzed pattern. So you should just assume it's not possible unless you're absolutely forced into it later on based on future development. And I just would never allow a second wave to retrace 99% of wave 1. I would rarely ever allow it to retrace more than 70%. And in that case, again, you want the end of wave 2 not to be that 70% retracement point, but you'd want it to subdivide and the conclusion to be at 61% or less of wave 1. If wave 2 is in different, it shows different kinds of patterns here. Let me go back one page just to make sure I'm not confuse anything. So wave 1 extended. Okay, so this is just talking about generic 2 waves, because it doesn't know whether wave 1 is the longest, wave 3 is the longest, or wave 5 is the longest, but it's just talking about the kind of behavior you might expect for a 2 wave generically in most patterns. If the third wave is the longest, then of course wave 3 has to be comfortably, or is the extended wave, it has to be comfortably longer, at least 161%, and probably closer to 200% of wave 1. It shouldn't be more than 261%. If it's much bigger than that, you're probably moving into more corrective action, or something else, maybe contracting triangle, in which you think is wave 3 is really wave A of a contracting triangle. So it's very important you keep the extended third wave between about 61 and 261% of wave 1. If the third wave is not the extended wave, then it goes into some details there and what's possible. Again, there's no point in me reading through that. This talks about the fourth wave and what can happen depending on which wave is the longest. Generally, if the third wave is the longest, wave 4 is going to take more time and retrace more of wave 3 than wave 2 did of wave 1. If it happens in reverse, that would be fairly rare for wave 2 to be the deeper correction and wave 4 to be the milder. It's not impossible, but it's very, it's very abnormal and not something you should assume unless you're forced into it later based on future action, leaving you know that no other alternative. Then when the fifth wave is the longest, the odds are extremely high that wave 4 will be the longest duration correction between 2 and 4, and that wave 4 will retrace more of wave 3 percent-wise than wave 2 did of wave 1. So again, that's all spelled out, and you can just sort of go through the checklist. If you have a 5-wave move and you know, or you think you know which wave extended, you can just find the section in the book, read about it, and make sure that what you thought was a 5th wave extension or a 3rd wave extension or a 1st wave extension really appears to obey the rules, and it all makes sense based on the evidence listed in the book or the details listed in the book. 5th wave failures are going to be extremely rare because that means you're concluding something very important. So you should not look for 5th wave failures very often. It shouldn't be something that you just throw in at any high or low, because the minute you have one, you're pretty much saying that that market has topped for a long time, or if the 5th wave, 5-wave pattern is going down, that it's bottomed for a long time. Now, long time is a relative concept. It has to do with the time frame you're looking at. So if you're dealing with a properly constructed chart where the complexity is managed between 13 and 55 monowaves, and you have a 5th wave failure on that chart, it means for that particular time frame, you've made a higher low that's going to last for probably 25, 50, maybe even 100% of the entire time of the chart. So it has to be a significant amount of time in relation to the time frame that the chart covers. If you have a 5th wave failure, you're immediately going to see the market drop quicker. If it's going up, drop quicker than the 5th wave, and there'll be no exceptions to that. You're not going to have to deal with phase 1 and phase 2 confirmation. If you have a 5th wave failure, it absolutely has to retrace all of wave 5 in the same time or less, and it should be much less. And it has to get to the 2-4 trend line in the same time or less. So there won't be any exception to that if the 5th wave fails. It's a very weak situation. It'll require very powerful if it's going down. It requires immediate violent reversal. So be very careful not to use this idea unless future price action indicates something very dramatic has just ended. Here shows an example of a 5th wave failure with a 5-wave move. This 3rd wave, if you want to put a little note in pencil in your chart, is probably too long. It looks like it's more than And let me get my measuring device out here. Well, it's right at 261% of wave 1, so it's right at the tolerable limit, but you probably wouldn't see it this dramatic normally, but it's possible, I guess. The fifth wave, you'll notice, is similar to wave 1, takes a little more time. It breaks above the B wave of wave 4. That would be pretty important. If you're going through a weak correction and the fifth wave fails, you at least want it to go back above the B wave of wave 4, but not make a new high. And the minute it's over, this drop would have to be bigger and faster than all prior declines, and it should retrace this whole move in the same amount of time or less, which in this diagram it does. Obviously, it's going to retrace this very quickly. It's going to break the smaller 2-4 trend line, the bigger 2-4 trend line, and completely retrace the last 5-wave move, and eventually retrace the entire 5-wave move, because this tells you this is the end of something really big. If you get a fifth wave failure in a C wave of a flat, same kind of thing. You're going to have a violent downside move that's going to retrace the entire C wave in the same time or less, and it should be less. And this drop has to be bigger and faster than the previous B wave decline. So those are all behavior traits that have to be present. Otherwise, your count's wrong. So if it just slowly moves this way and takes more time to break this low, then it's not a fifth wave failure, and something else is going on. Okay. This has to do, let's see, trending. Looking at my book is a section. Oh, this has to do with terminal patterns. So it didn't see it actually where it said terminal. Okay, where is it? I don't see the term terminal, but it actually should be there in the page. It looks like Kindle, Amazon messed up on the copying of my book. Oh no, here it is, right here at the bottom. Okay, so terminal. This is beginning the terminal section. It talks about a terminal with a first wave extension and what you would expect to happen. Terminals, like triangles, are the exception to all the general rules of impulsive patterns. So when you get a terminal, wave 2 can retrace 99% of wave 1. Wave 4 can retrace 99% of wave 3. Wave 2 can take less time than wave 1. Wave 4 can take less time than wave 3. They don't have to, but they're allowed to when you're dealing with a terminal. And the concept of extension isn't quite adhered to the same way it is as it is in a normal 5-wave move. So an extended wave in a terminal means it might just be, 138% or just a little bit longer than the next longest wave. So extension rules don't apply to terminals the way they do to other 5-wave moves. It's just whatever wave is the longest would be the extended wave. It's allowed to be 161. It could even be maybe 200% of the next longest wave, but it doesn't have to be. What you do have to have is overlap between waves 2 and 4. So some of the same price range of wave 2 has to be shared with wave 4, not all of it, but some of it. And the third wave can never be the shortest. And when that pattern comes to an end, you're going to get hyper violent counter trend market behavior. So whenever you're dealing with a terminal, if you think one occurred, you can't see the market just meandering down. It's mandatory that it completely retraces the terminal in 50% of the time or less, and generally around 25% of the time. And it only occurs at really major turning points. So whatever time frame your chart is, it's going to take longer than that entire properly designed chart before the market actually exceeds the high of that terminal if it's going up, or the low if it's going down. So it's going to be a very extended period of time before you're going to move above the top of the terminal or below the bottom. Just again goes through some of the character traits you would expect. Third wave extensions, I did not know this existed until the crash of '87. So if I'd read my book a little bit earlier, it would not have been listed, but it was re-released in 1990, and it was up at the high in 1987. The market was starting to behave a little strange, and I wasn't quite sure what was happening, but I knew we were supposed to see a 5-wave move at that point, but its design was different than I was used to, and so I had to actually determine in advance before it actually finished. This was right before the crash of '87 started, that the market must have created, or wave theory had created, a new kind of terminal pattern, at least one that I had never seen and one that's not talked about in any other books. And so that's a terminal where the third wave is the longest and 1 and 5 are more similar. And I actually realized it was going on and sort of hypothesized that was the only option left because no other logical possibility existed. And it turned out to be correct, and the market started to collapse. And that's how a lot of the concepts in my book were created, from teaching and constant wave analysis of markets and providing market updates and logically thinking through situations. And if logic didn't allow me to come up with any kind of conclusion that made sense, I had to assume that some kind of new behavior was occurring. And that's how diametrics came into existence, how symmetricals did, how third extension terminals did, and neutral triangles. So that's where all those came from, because they weren't adhering to the behavior characteristics of patterns that Elliott originally discovered, and they were occurring in positions that didn't make sense based on what I previously knew. No point really going through the details of what each one of these is. If you're looking at a terminal pattern, just make sure you figure out which wave is the longest, refer to the proper section, and see if it follows the rules as listed. And if it does, and it produces the right counter trend post pattern behavior, which is discussed in chapter 6, then the odds are very good that you've analyzed your chart correctly and the market is confirming it by its post pattern behavior. Let's move on to corrections. Corrections are going to follow similar guidelines here, where you're going to decide if you're on a flat or a zigzag or a triangle, and you're going to refer to this part of chapter 11 to make sure it follows the rules. So obviously you're not going to be reading through chapter 11 at this point. If you've already read through the book a few times, you're trying to apply it in real time, you're just going to jump to the proper section of chapter 11 to confirm that what you're looking at makes sense and appears to follow the rules. There's different types of flats. There's flats where the B wave is slightly shorter, the C wave is slightly shorter. So I gave them all different names. B failures, C failures. A lot of that's not terribly important, what you call it, but just that you're aware of the logic and the power that passes from one formation to the other. So if the B wave is smaller than wave A, that implies strength in the direction of the correction. So if the correction is starting down with wave A, that means the C wave is almost for sure going to make a new low if the B wave is comfortably shorter than wave A. If the B wave is the same size as wave A, then you run into risk of a C wave failure, because the B wave is what tells you if the correction is strong, weak, or normal. Normal would be a B wave finishing around the length of wave A. Weak would be around 61% of wave A or less. Strong would be maybe 110, 20, 30% of wave A. So the crucial wave in all corrections, especially flats and zigzags, is looking at the behavior of wave B. And that's going to tell you a great deal about what's going to happen when the correction is over. Because the move after the correction, if it's a flat or a zigzag, the move after the flat or zigzag will always move faster and further than the B wave of the correction that just ended. And that's a way that that's the way the market self-confirms. Some of y'all had questions recently about self-confirmation and self-definition and the logical integration of patterns. So that would be an example of self-definition, where the B wave defines the exact minimum price time parameters for the future move after the correction is over. So these are very important things to use when you're trying to predict what's going to happen after a flat. If the B wave takes 10 days and $10, you can take that price time window, measure the B wave, and then move it to the end of wave C and predict the minimum price time movement that has to occur after wave C. If it doesn't produce it, then it means you're getting a D wave or an X wave. You're not getting the start of the new trend. Okay, it just shows some different examples of what might happen and explaining the kinds of behavior you might get. So if the C wave is extremely small, this would be super rare, and only if the market is getting ready for a spectacular move. If the C wave failed this much, I would probably expect the move after this B wave added to here to be probably 161 to maybe 261% of the size of wave B. So a severe failure implies tremendous strength to the downside if it's going the opposite direction. If the B wave fails and the C wave fails, well, then it sort of neutralizes each other, and it's hard to tell what's going to happen next, but it still should at least produce behavior equal to or greater than the B wave itself. If the B wave is only around 61% or less, it's virtually mandatory the C wave is going to make a new low. This diagram should be marked as impossible. I mean, maybe if you're in a neutral triangle, maybe, but the B wave should never be simpler and less time consuming than the A wave. So, and that's for any pattern. Be extremely rare. The only pattern in which that might happen is what's called a neutral triangle, and that's where wave C is the longest. So mark this diagram as only being possible if the C wave was corrective and you were in a triangle and the C wave is going to be the longest wave. But it would be, I mean, in my opinion, I would never, ever allow this to happen. If the B wave is going to be less time consuming and less price consuming than wave A, it needs to be much shorter. So I would just mark this chart as illogically designed, and that wave A should have been violent and wave B should have subdivided. That's the proper way for this flat to have developed, not with A subdivided and B not. That never happens in flats. So you need to mark that this is backwards, okay? This chart shows some time relationships you might see in flats where A is very short and quick and B subdivides a decent amount, and C might be equal to B, C might be equal to A plus B divided by 2, or they might all be slightly different, but the normal relationships which are spelled out in your cheat sheet is that if A and B are very different, C will be equal to A plus B divided by 2. If A and B are very similar, C will be equal to A plus B. If A and B are not dramatically different, but not that similar, then it makes it very difficult to predict what wave C is going to do. Here shows an example of a flat with a C wave terminal. This terminal is probably a little too elaborate, so you might want to mark that this would be a little too complicated compared to wave A being a mono wave and B just being 3 waves. You would want it to be more simple, so just 1, 2, 3, 4, and 5, and not having all this complexity in here, because that makes wave A and wave C look like they're 2 different degrees and not part of the same pattern. So just mark that this wave 2 and wave 4 should have been mono waves, not polywave patterns. But wave C would fail here, and as a terminal, that would make some sense. A and B are the same. C wave is a terminal, it fails, so the failure implies strength, the terminal implies strength, and the market would take off, you know, hyper violently after this kind of structure. You should rarely ever accept the C wave being less than 61% of the B wave, because the B wave is a correction, and a correction should be retraced at least 61%. So if it's less than that, you need to be very careful and make sure that the move after this is super violent, because this is an extreme failure. It means the markets, the conditions maybe have all of a sudden changed for some reason, it's getting ready to take off, but do not allow failures of this tiny amount unless there's really good future price action to justify it. Okay, this would be a sort of a common flat where A, B, and C are all about the same. Again, this A wave should not have subdivided, the B wave should, and the A wave shouldn't. These are, you know, very common ways for a flat to develop. Doesn't really imply any strength or weakness. It's just sort of a normal neutral situation. Let's see. Give some examples of where patterns might occur, which is helpful when you're putting together a larger structure and you say, well, this happened in the proper place, or it didn't. If it didn't, then you need to rethink what you're doing and maybe consider something is wrong with your count. Wave B here is less than 81% of wave A, and the C wave failed to make a new low. So this would be what's called a double failure. It doesn't really imply very much. It's sort of a neutral implication. The market may or may not move up quickly, but it still has to be at least as big and as fast as wave B. It could be bigger, but it can't be slower, and you know, less. It can't be more time consuming than this and be smaller in price. Shows sometimes you have complex structure. As long as you're controlling the complexity of your chart, you might have an A wave that goes through this elaborate complex structure, finishes above the low, the B wave rallies, the C wave is a 5-wave move, and the C wave ends around where the contracting triangle of wave A ended. That would be very common because a contracting triangle typically will provide Fibonacci support and critical support in the market. So wherever it ends, that level typically will not be broken unless the market's going to go a lot lower. And if it's going to go a lot higher, it won't break it and eventually reverse. So you can use contracting triangles as support and resistance levels in the market to determine whether it's weak or strong. So if it doesn't break it, it's strong. If it does, then it would be weak. Elongated patterns, I haven't seen a lot of those for the last, I don't know, probably 10 years, but they mostly only happen when you're in triangles. So if you have an A and B that are similar in a C wave that's a lot longer, you should immediately assume that this pattern is probably part of a bigger triangle. So it would either be not likely wave A, because you want wave A to be the most violent in most triangles, at least contracting and expanding, but the B wave, the C wave, the D wave, or the E wave could have a design like this. So if you see an elongated flat, most likely you want to make this the B, C, or D wave of a triangle. As far as timing, it's just going through another example of that A and B are similar, add A and B together, and you get the time of wave C. That would be very common. Okay, now this part of the book, we're going to have to make some adjustments here because I didn't understand as much about triangles back then as I do now. So we're going to have to talk about, how they really behave as opposed to what I thought was the case 30 years ago. Let me finish this discussion about elongated flats and then I'll get into that next. So here you can see, this is probably not a good example again because you want wave A to be the most violent wave. So you're not going to see an elongated flat as part of wave A. It's going to probably happen in the B, the C, the D. Not likely the E wave, but the B, C, or D waves is the most likely. This would be violent, and then you might get an elongated pattern like it shows here. This elongated structure is too elongated, by the way. So you should put a little mark here. You don't want the C wave to be more than about 261% of wave A. So this is exaggerated to the extreme, and it should not occur like this in the real world. So just make a little note about that. Here it shows situations that might look like elongated flats, but may not be, where you might have a contracting triangle that gives the appearance of an elongated kind of flat, but it really is the pattern finishing here and the new structure starting there. You shouldn't ever have an elongated flat where the A wave goes up and the B wave makes a new low, and then the C wave is this violent move up. That should not be allowed because this would imply weakness, this implies strength. They're contrary to each other, so it's illogical, so you should not allow it. Okay, here's irregular, what did I call this? I can't remember, just an irregular. Okay, so here's an irregular pattern where the B wave is a little bit bigger and the C wave is a little bit bigger. That's perfectly acceptable, doesn't cause any problems, but the bigger the B wave gets, the less and less likely this can happen. And again, this A wave should have been a mono wave, the B wave should have subdivided, so mark that should have been reversed on this chart. So this kind of irregular is only possible if wave B is not a lot bigger than wave A. If it starts moving to the 125, 30% range, it's almost impossible for wave C to make a new low. So make sure you only allow for an irregular if the B wave is not much larger than wave A, and then the C wave won't be much larger than wave B. So here shows where as the B wave starts to get larger and exceed about 138%, you should no longer expect the C wave to make new lows because this implies strength. If it were to make a new low, that would imply weakness, which would be contrary to the structure and illogical, so it's not allowed. The bigger the B wave gets, the stronger the future move is going to be, and the more wave C and wave A will be similar to each other. The only difference is that if wave A and B are very different in time, you want to make sure to add the time of A plus B divided by 2, so the C wave doesn't take enough time to be appropriately connected to this A and B. So just put a little note, the C wave should take half the time of A plus B right here. Okay, so now we're moving on to zigzag patterns. Zigzags, of course, are patterns in which the B wave is no more than 61% of wave A, and you have to make sure wave C makes a new low. You can never have a failure to make a new low in a zigzag. That's only allowed in flats, and only if the B wave is at least 61% of wave A, and normally if the C wave fails, the B wave is going to be close to 100% of wave A. So again, it just goes through some descriptions of behavior, what you might see for zigzag for wave A, and what can occur and what's allowed, what the B wave might do, get some diagrams of that. So there's not a lot of point in going through that. It's just describing their behavior. Now for the triangles, this is the part we have to make some new adjustments to this section. When I wrote the book, I didn't understand that triangles were basically like impulsive patterns that go sideways. So you have in an impulsive pattern, wave 1, 3, or 5 can extend. So in a triangle, wave A, wave C, or wave E can extend, but triangles go sideways. They have overlap between the waves, and each segment is corrective. Impulsive patterns, trend, and you'll have no overlap between 2 and 4, and 1, 3, and 5 are impulsive in nature. So that's what separates them, but they still have the same connection between the first, the middle, or the last wave being the longest. So when it comes to triangles, your focus shouldn't be on what it looks like or how it channels or how wave B and D behaves. It should strictly be on the behavior of wave A, C, and E, and how they relate to each other. So probably 90% of the time or more, in all triangles, wave A will be the most violent. The only time that's allowed to not be the case is if you're in a neutral triangle where wave C is the longest. But if it's a contracting or expanding, wave A will always be the most violent wave. Subdivided, it moves the quickest, and it's over with very fast. The B and the D need to overlap in all triangles, but sometimes the B wave is bigger, sometimes the D wave is bigger, and this is applicable no matter which wave is the longest. So if wave A is the longest, wave B can be shorter than wave D. It's going to look really weird, but as long as wave C is 61% of wave A and wave E is not bigger than wave C, it would qualify as a contracting triangle. So contracting triangles mean that wave A is the longest, the C is around 61% of wave A, and the E wave is not longer than wave C. And then of course you have alternation between B and D, and you want there to be overlap between B and D. As long as those rules are met, then you may have a contracting triangle, and then the proof of it will be the post-pattern behavior, in which the thrust out of the triangle is going to be equal to the widest leg, which should be wave A, and it'll peak around the apex point of the triangle if there is one. Sometimes if the triangle has a weird design, the B wave is shorter than the D wave, it may not have a contracting bias to, channeling to it, so you're not going to have an apex point to deal with. But probably 90 to 95% of the time there would be a contraction. You'll be able to see where the apex point is, and you can see that when it thrusts, it'll peak or trough right around the apex point of that triangle, and that would constitute what's called a limiting contracting triangle. A limiting triangle is a B wave or a fourth wave, so that final thrust is the end of the move. It's either wave C or wave 5. A non-limiting triangle is one that happens in unusual places. It completes complex formations, or it might be the X wave of a complex correction. So those are non-limiting triangles, where after the thrust, the market can continue to trend way beyond the apex point of the triangle. So I already explained what contracting triangles are. When we go on, this shows some examples here where and this is probably not a good example. You want wave A, you have to have wave A longer here. So the C wave in a contracting triangle is almost exactly 61% of wave A. And that's one of the tall tale signs of a contracting triangle. So for this diagram, you need to mark that wave A needs to be up in this territory. Let me measure wave C real quick. Hold on 1 second. So the A wave would have to start right about here. So that would make wave A 161% of wave C. The B and the D would overlap. The E wave finishes inside the triangle. It could, or it could even break. It doesn't matter, as long as it doesn't go below here, preferably, but it cannot be longer than wave C. So it's technically possible. It could break the C wave low as long as it's shorter than wave C. And then it would need to violently reverse and thrust approximately the width of wave A. And that thrust needs to finish around the apex point of the triangle. Getting a question here, could you please explain about third extension terminal? Okay, a third extension terminal is similar to a triangle, but it has a little more specific requirements to trend, and you can get more extreme alternation between 2 and 4. And after it's over, you're going to get, a market that's going to be at a major top or a major bottom, so it's going to trend for a very long period of time. So obviously it can't be, in a B wave or fourth wave position. It only can be the very last wave, either wave 5 or wave C if something much larger. So a third extension terminal means that The third wave is the longest, not wave 1 and not wave 5. So it won't have an expanding look. It won't have a contracting look. The biggest wave will be in the middle as wave 3. 1 and 5 will be more similar. 2 and 4 will overlap, and sometimes they alternate to the extreme. Wave 2 can't retrace all of wave 1, but it could be up to 99%. Not likely, but it's possible. Wave 4 could be up to 99% of wave 3, but it needs to alternate with wave 2. So if wave 2 is very extreme in its correction, wave 4 will be very tiny. If wave 2 is very tiny, wave 4 will be very large. They need to overlap, and that's what I call extreme alternation. It's only allowed in terminal patterns, not in triangles, not in anything else, just in terminal patterns. Terminals are pretty much the exception to all rules, and part of their goal, of course, is to trick people and not make them aware of what's happening so they don't catch the really good trend that's about to start. So I don't know if that answers your question, Panchai. Can you let me know if that did it or not? I could open up your mic. Let's see. Okay, your mic is on, okay, you said yes, okay. So any other questions about third extension terminals? Your mic's unlocked if you want to talk.
Yes, I want to ask you, can you show me the diagram or in the real world chart?
That would be very hard to find because I haven't seen one in a very long time. We might be able to look back in the S&P, but that happened, last time I remember it happening was in 1987, and I'm not sure if I have daily charts that far back. I have, monthly, but I don't have daily that far back anymore. So I'm not sure if I can give you an example right now, but it'll have to be after we finish chapter 11 if I can find one.
Okay.
Okay. Okay, so let's move on. So the other rules for typical contracting triangles, and again, make this A wave 161% of the C wave. Generally, you want it to finish so that when you measure from the conclusion of wave E back to the beginning of wave A, you take 20 to 40% of that time and add it here. The triangle will conclude, the triangle, the peak, the apex point will occur somewhere in there, in that range, and that's where the market will top. So it says the apex will usually terminate at times on around 38% of the time consumed by the whole pattern. So if you measure the whole thing, add 38%, this will be approximately where the apex point will occur, and that's approximately where the thrust will end. In a normal contracting triangle, the end of the triangle will occur somewhere around 61% of the range of wave B down to 38, up to 61, but somewhere in this range of the middle of wave B. That's gives you some warning early on about where it might end. Now that only applies if the triangle is going sideways. If it's drifting upward, that won't apply, but most triangles don't drift, they go horizontal. Let's see. This just goes into discussion about the behavior of each wave of different kinds of triangles. Not a lot of point going through that because that only will apply if you have the specific pattern unfolding. So you'd have to be looking at a contracting triangle that appears to be in the B wave or the fourth wave position. Make sure it follows these rules, and then you could go through the behavior of each wave in the pattern. So horizontal contracting triangle, you'd look at wave A and see if it's doing what's suggested, and go through wave B and C and D and so forth. An irregular triangle, this is where we need to jump off and get out of all these weird terms for triangles, because the type of triangle forming is strictly determined by the length of wave A, C, and E in relation to each other. Wave C will never be the shortest, just like wave 3 is never the shortest in a 5-wave move, so it's very important you make sure that rule is not broken. But the type of triangle you're in is solely dependent on which wave is the longest. So if the A wave is the longest, it's a contracting triangle. If the C wave is the longest, it's a neutral triangle. If the E wave is the longest, it's an expanding triangle. Nothing else matters. It doesn't matter what you call it. That's what determines expansion, contraction, or neutral triangles. For a few years, when I wasn't quite clear on this concept, I had a concept called an extracting triangle because I didn't quite understand what was going on and how to deal with these weird variations that were happening. But don't get confused with all that stuff. Just focus on which wave is the longest and which wave is the most violent. Most violent should be wave A. The longest should be A if it's contracting, E if it's neutral, and E if it's expanding. And then, of course, you're going to have the alternation between B and D. You will not have extreme alternation in a triangle. That only happens in terminals. So the B wave is going to have to be somewhere in the 38 to 61% range of wave A. The D wave is going to have to be in a similar kind of range for wave retracing wave C. They have to overlap, and the final structure has to follow the rules of wave C not being the shortest, wave A being almost always the most violent, and one of the waves being the longest, and so forth. So don't worry about all these different terms, irregulars and running triangles and all that. I mean, it doesn't really matter. What matters is which wave is the longest, and making sure that wave A probably 90% of the time is the most violent, with the only exception being a neutral triangle. Sometimes in a neutral triangle, wave A is not the most violent, it's wave C in that case sometimes. I'm going to move on. So here's an example of a running triangle. Still, the A wave should be longer here because it's a contracting triangle. It would need to be about 161% of wave C. If it's going to be a neutral triangle, then the C wave should be 138% or more of wave A. In this case, they look the same, so this really wouldn't qualify as an contracting triangle. So either wave A has to be bigger or wave C has to be bigger. But it gives you the idea of the drift, and that drift implies extra strength. So the thrust would be a little bit bigger than the biggest wave of the pattern, which in this case is this one right here, added to this point here. But normally, the A wave still is going to be the most violent. So you'd have to have the A wave would have to still be 161% of wave C. So no matter how the B wave behaves, you still want A and C to relate by 61%. And I may have seen one exception to that in almost 40 years, so you should just assume it's always going to happen. Non-limiting triangles, again, are patterns that occur not in the B wave or the fourth wave position, but typically occur as an X wave or at the end of patterns. So here you have a triangle that doesn't end with wave E here and then the thrust. It keeps pushing into the apex point, and that's a sign that you're going to be dealing with a non-limiting triangle. So the thrust will not be the end of the trend, and it will not correlate to the apex point. Quite often it'll just keep going past that point, and the thrust could be bigger than the widest wave, and the market just keeps trending. So that's a major clue. If you have the correction going into the apex point, you know immediately it's not a B wave, it's not a fourth wave. So you need to make sure your count doesn't assume that. Again, it goes into specific behaviors of each one. Here's some examples of how you might get a non-limiting triangle. Triple threes are so rare, I virtually have never seen one, and they don't happen this way anyway. They're always going to drift up or down with the market, but a contracting triangle can easily happen at the end of such patterns. So let's say you have an ABC and the X wave was bigger, and then an ABC and the X wave was bigger, and then you have a contracting triangle at the end. The move after would be extremely powerful, because a triple three that's drifting upward would imply a lot of strength. Because remember, this is a correction that's supposed to be going down, but it's drifting up. The move is going to be very big, and it's going to be bigger than the move that happened before. Getting some questions again. Let's see. Is a running triangle generally a continuation pattern? Yes, because if it's not a continuation pattern, that means it's a terminal, not a triangle. So how do you tell the difference between the two? This is very important, and it has to do with observing the violentness of the market. So if the violent nature of the market is going down and the slower movements are going up, then you know the trend is down. So if the trend is down and this is supposed to be wave one, that's two, and this is three, well, that won't work because wave three has to make a new low. Let me go back to the previous pattern, running triangle. Okay, so let's assume that you thought, well, maybe this is a terminal pattern. We had, trying to figure out how I'd make it a terminal pattern. Maybe wave 1, 2, 3, 4, and you thought this was wave 5 and it would be the end of the pattern, the market was going to collapse. You can know that's not correct by the internal behavior of the triangle, because the violent moves will be going down, telling you this is wave A, this is wave C, and this is wave E. The slower moves up can't be the wave 1, wave 3, and wave 5 with the violent moves down. Remember, violentness occurs in the direction of the trend. Slower action occurs as wave B, wave D, wave X, wave F if you're in a diametric. So that's how you know the difference. That's how you don't get caught in having contracting triangles that thrust out the wrong direction, because you're looking for the violent move in the direction of A, C, and E, and the slower movement in the direction of B and D. So that helps you to avoid assuming the breakout's going to be in the opposite direction that you thought it was going to be. So if the violent moves are down, the breakout's going to be up. If the violent moves are up, the breakout's going to be down for a triangle. In a terminal pattern, you're going to have very trendy action. The counter moves probably won't be that dramatic, shouldn't be violent for sure, but the moves up will be more trendy and look more powerful and more violent than the down moves. And then of course, the third wave would have to be shorter than wave 1, the fifth wave would have to be shorter than wave 3. So the minute this move would be bigger than this, then you know that scenario is out. Not sure if that answered your question. Can you let me know in the question section if that covered your question? Okay. So let's move on to, here's an example of a contracting triangle, non-limiting because it's not a B wave and it's not a fourth wave happening at the end of what's called a double 3 running correction. So you have a big move up, an impulsive pattern, a correction, and then the X wave makes new highs. You would need to make sure this X wave takes no more time than this pattern right here. Otherwise, this would be wave A and that would be wave B. Let me just measure real quick. Yeah, so the X wave is a little bit less time consuming, so it could qualify. It's a little bit larger than you would normally see. You would normally want to be about 161% at the most. So this is a little bit too big. You might want to put a little mark there that the X wave is too large price-wise, but time-wise is fine. And then after that, notice the violent movements are down because that's the direction of the A's, C's, and E's. The violent move here is A and C. Slower moves are going up. So it tells you what direction the trend of the correction is in, and that the future breakout is going to be in the opposite direction of the corrective trend. So corrective trend is going down. When it's over, you're going to get a violent move up. This drifting correction is very strong, so the move here is going to be larger than the move that was before it. Let's give some more examples of where you might see triangles. Again, you don't want the A wave to be slower and more subdivided than the B wave, so mark that this chart is backwards. You want the A wave to be violent and the B wave to be slower. But here you could have a zigzag, an X wave, and then a contracting triangle. This is probably a little too elaborate for this simple zigzag. So it'd probably just be a mono wave for A, mono wave for B, mono wave for C, for D, and for E, and it wouldn't have all this extra subdivision. So the complexity is a little too great here compared to this. Remember, you want patterns to relate to each other, following the rules of similarity and balance, not taking too much time, not too much complexity, so it can relate to the pattern that occurred before the X wave. Most of the time when you get an X wave, the move after will be very similar in time and price and complexity to the move before. So that's why you would want to reduce this and not make it so complicated as I have it diagrammed here. Here's an example in the opposite direction where the market's been going up through a complex triple kind of double zigzag, then an X wave, and then a contracting triangle. Again, the violent movements are going up, but the market is not making new highs. It's contracting. The C wave is about 61% of wave A, or it should be, and that would be your warning that the market's about to top and conclude a complex correction with a non-limiting triangle and then thrust downward. Because an impulsive pattern, a terminal impulsive pattern is all corrective, wave 1, 2, 3, 4, and 5 are all corrective. That means the fifth wave of a terminal could be a contracting triangle because that is a correction. But again, your violent movements would be going up, and when it's over, then the violent movement would go down to start the downtrend. Here shows a non-limiting contracting triangle as an X wave separating two zigzags. And here the complexity level is tolerable. The X wave is not much more complicated than the other pattern. It really should be only 3 waves, not 5, because you don't want it to be more complicated or time consuming than the previous pattern. So we probably should have removed one of these and put the X wave right here and then have this next zigzag take off. Remember, X wave shouldn't be more than 100% of the time of the previous pattern, no more than 100% of the complexity, and should not retrace more than 61% if the trend's going to continue. If it's not a trending correction, but a sideways correction, then the X wave is likely to be bigger than the previous ABC. So you have a flat, and the X wave will be bigger in price. But you want to make sure the complexity isn't higher than the previous pattern, that it retraces at least 1/3 of the time the price and the complexity, and not more than 100% of the time in the complexity. And it can't be more than 61% if it's trending like this. Expanding triangles are a little more difficult to deal with, but they're going to follow the rules that I mentioned to you earlier. your A wave will be the most violent, and it'll be the smallest. The C wave will be the next largest, and the C wave should not be more than 161% of wave A, but it should normally be less. And the E wave is going to be the largest wave, the most time consuming typically, the most complicated. And the B and the D have to overlap. Normally the alternation will be in what I call the standard kind of alternation, where the D wave is bigger than the B wave. Once in a while you get reverse alternation, so the B wave can be bigger and the D wave can be smaller, but the real focus, as in all triangles, is figuring out which wave is the longest. It doesn't matter the way the B and the D wave behave. That doesn't determine the kind of triangle you're in. It only matters which wave is the longest. So you're looking for which wave is the longest first, and then after you determine that, if the E wave is the longest and you're in an expanding triangle, then you have to make sure B and D overlap, that they alternate with each other in as many ways as possible, and that when the triangle is over, normally the E wave of an expanding triangle will not be completely retraced, and the movement after will be frequently slower than the E wave itself, but it'll take more time to retrace all of wave E if it eventually does retrace all of wave E. And that's what some of these rules are describing here in this section. I really wouldn't waste any time with limiting and non-limiting expanding triangles, because it's very rare for them to happen in almost any position except the B wave of a flat. I guess they can happen in some complex formations at the end of complex formations, like, you know, a zigzag, an X wave, and then an expanding triangle. But expanding triangles that continue a trend, it's very rare. It normally only be the B wave followed by wave C. Otherwise, it's going to be the end of something and the start of something new, typically. I do remember one situation where expanding triangles can be followed by X waves. So you might start a pattern with an expanding triangle, get an X wave that's smaller than wave V of the expanding triangle, and then you get a contracting triangle after. I have seen that a few times in the past. You get an expanding triangle, an X wave, and a contracting triangle. So the whole pattern mostly goes sideways. But most of the time, if you get an expanding triangle, it's going to be the B wave of a flat. Okay, so that finishes off chapter 11, and we have some time because, as I mentioned to you, my next class, I don't have a class after y'all now. So I wanted to try to catch up on some of the emails. Let me do that now. I thought it was still open, but apparently it's not. I have about 5 emails, I think, that are here. Okay. So Hamid, like always, has a lot of questions. So let's see if he's in class. Yes. Okay, so let me unlock your mic. I'm not sure if these questions back from January 3rd are still relevant. Are those still relevant or not?
Yes, they are.
Say that again?
We can ignore that chat.
You're making a lot of noise next to your mic. I can't understand what you're saying.
Can you hear me?
Yeah, I can hear you, but you're shuffling stuff around and it's making your mic very noisy. Maybe because you're typing at the same time you're talking, you can't type because it's making too much noise.
Is that better?
So what's your question?
So my question is, can we get rid of that chart, please? And I sent you the last.
You want to get rid of this chart, you said?
Yeah, because I've analyzed it and I thought best.
So am I getting rid of this entire email?
Can we go through these questions, please?
I think we went through some of them already, didn't we?
It's been a while.
Can anybody remember if we went through any of these questions last time? I think we went through some of them at least. Okay. So the S&P chart you're talking about, is that monthly, 6 monthly? What time frame was that question on regarding?
Let me check.
These charts are opening in the background, so it's going to take a minute for them all to update. I haven't opened them in a while. Probably shouldn't have opened so many charts. Some of these, okay, there's the daily chart. Yeah, it has to update all the data. That's why it takes a while here. So give me a second. Okay, I think all the charts are now open. Let me move them over a little bit. Okay, so do you know which market, which time frame you were talking about on the S&P?
I think it's where wave 4 is drifting upwards, and it's
So you're probably talking about the long-term count?
yes, yeah.
Okay.
The question I had was wave 4 is drifting upwards, so it's concluding at higher, higher than wave 3 is. So doesn't that make it a correction? A wave 3 is a corrective wave because it's concluding at a higher level.
We have to take a look at the chart, but so that's a monthly. I don't think that was it. That's weekly. This is half yearly. Okay, so I think this is the chart you're talking about.
One higher than this, I think. Yeah, that's it.
Okay, so what about this chart?
So basically, wave 4 is concluding higher. When you said a wave.
It's probably going to end right around the peak of wave 3, give or take a little bit.
So
basically,
basically,
I don't know exactly where it's going to finish.
So you've said before that a wave should be retraced at least 33% to be considered a motive wave, and we've retraced a tiny bit of wave 3, and we're concluding at a higher level.
Are you talking about this third wave here?
Yes.
Okay, yeah, that has to do with because the fifth wave is the extension, and if you go into, I think it's chapter 5 where it talks about the behavior after a fifth wave extension. I think it was chapter 5. Let me just see. Maybe later on in the book. Yeah, it's probably later on. Not sure exactly where it discusses it, but it goes through the specific minimum requirements for behavior after fifth wave extension. And the minimum behavior is that you need to retrace 61% of the fifth wave, which this is right at 61% of that amount right here. And it needs to break the 2-4 trend line in less time than the fifth wave took to form, which it did. So both of those requirements were met. And the market, has continued to go sideways for quite a while and then go up. So it looks like this is correct based on all the evidence. It's a very minor retracement of what appears to be a pretty large 5-wave move. It's probably only around 25%, so it's fairly small. Actually, sorry, this is the actual low. Let me measure it to there. Yeah, it's getting much closer, but it's probably around 33% right here. So it's right at the minimum level of acceptability for a typical impulsive pattern to be retraced. This is less, but this eventually gets to that point because this is the elongated C wave of a neutral triangle. That's where you're going to get the biggest move. And so it's right at about 33% of the entire distance of wave 3. So that, sorry, I messed up the whole chart. Try that again. It's a little bit less, but you can see it's very close. There seems to be no other explanation for what's happening, so I'm assuming it's correct until proven otherwise.
Right, okay.
Because you can see, it's very obvious which direction the trend was here. The trend was clearly up, this was counter trend, clearly up. Then all of a sudden the violent moves were down, the corrective moves were up. The violent moves were down, the corrective moves were up. So we know we're in a downward correction now, so this has to be wave 4. I mean, there's really no other choice. Or it has to be something after. This could be wave 1, this could be wave 2, this could theoretically be wave A, and this could be wave B. None of that matters as far as the fact that the behavior is telling us the trend of the correction is down, the counter trends are up, but that correction is drifting upward, which implies a lot of long-term strength, and that the future bull market is going to be unbelievable. Does that make sense?
Yes, yeah, that makes sense. Thank you.
I think this is a log scale chart. I'm pretty sure it is. So it might be a little bit better if we used a 10x log scale. I'm not sure, but it should be pretty much the same. Okay, so that takes care of that question there, right?
Yeah.
So it's right around 33% retracement, a little bit less, but pretty close.
So the conclusion doesn't matter as long as the previous wave is retraced.
Oh yeah, no, the conclusion doesn't matter as long as some part of a retrace is about 33% or more.
Right. Okay, that makes sense.
Okay. So is this regarding the move after wave 4 is over?
Basically, when you have a new trend that starts, does that mean the new trend has to be faster than the counter trend move? So say, for example, you've got 1, 3, and 5, and we're in the third wave, and we're making, an ABC flat. Now, does that mean that when we're starting the fifth wave, from the fourth wave, the wave 1 needs to be larger and faster than wave B of wave 4?
Wave D of wave 4. This will be the last wave of the previous correction. So this length added to this low.
No, basically the question is, say we're in wave 3. This is just a generic pattern. So you've got wave 3, then we make a flat pattern, A, B, C, and then form the fifth wave. Wave 1 needs to be faster than wave B of that flat. Is that correct?
No, the entire fifth wave has to be bigger than wave B in the same amount of time or less.
Right. Okay.
Okay, because you're talking about a lower degree has to be smaller and less time consuming than a bigger degree. You don't necessarily have the ability to predict what wave 1 is going to do unless you have more complexity to help you do that. But if it's a very simple chart, then all you have is, like, say this is the B wave and that's all you have, well, then that's the entire minimum projection for wave 5 price-wise and maximum time-wise for it to achieve this, because this is a counter trend rally against a downtrend. When you're in an uptrend with the uptrend, or impulsively moving with an uptrend, you have to move further and faster than a counter trend move of a downtrend. It makes logical sense, right?
Right, yeah.
So you just know that the fifth wave has to be bigger than this and take the same time or less to achieve what the smaller degree pattern did, to prove that you started a new trendy phase. And once it's done that, then the fifth wave could end at any point as long as it's obeying the rules.
Is it possible to find this out on a smaller time frame where you are ahead of
you have to go to 6 monthly charts.
Right, okay.
So you go to 6 monthly charts, but you have to remember, controlling complexity is crucial to good wave analysis. This chart is starting to push the limits of 55 monowaves, so it's starting to become a little shaky in the reliability category. So I would stick with this as the big picture, which would guide the structural analysis on this picture. And I'm not going to look at the big picture. I'm going to focus just on this, and mostly just this final portion here on smaller term charts, to try to get an idea of what's going on with this final advance. If this is an X wave, then the next move up should be at least similar. It could be 61% of this in time, 61% in price, or it could be 100% or 161%, but somewhere approximately like this added to this low. We've already almost achieved the minimum requirement of a thrust out of a neutral triangle, which is 75%. It's clearly not going to make it to the 100, and I may have warned y'all previously that the thrust out of a neutral triangle doesn't have to be as big as the biggest wave. It could be as little as 75%. So here it's probably going to achieve that, and that's about it.
Right, okay.
Okay, so in a contracting triangle, you want the thrust to be about 100%, give or take a little bit. Neutral triangle around 75%, give or take a little bit. An expanding triangle only around 61%, give or take a little bit.
Right, okay.
Okay. Okay, let's see. Yeah, you don't want this to happen. You would have to have extreme alternation differences between 2 and 4 in structure and complexity and time to potentially allow for this, but this would not be good. This is more like dealing with a double zigzag or something, not with a 1, 2, 3, 4, 5.
Right. Okay.
Okay.
Question 6. Your
So I'm
wave
skipping
4.
number 4.
Yeah.
Okay, so you're talking, yeah, remember time is measured from high to low, but
Yeah.
from beginning to end, wave 4's time equals wave 3 right here. That's how I knew wave 4 couldn't finish for about 20 years, because that's how long wave 3 took. So until we get past this point, it can't be finished, and wave 4 can't finish with a rally. It has to finish with a decline. It has to be decline significant enough to compete with these, and time consuming enough to be half of this plus this, because these are very different. So we're talking quite a few years of down and sideways action, about 5 years probably, whenever this finally tops. And this E wave should be similar to the A wave because the C wave is the biggest. Okay.
Right. Okay. Can you have a look at the chart I've sent you? We can just ignore. Been going through the questions. You can just ignore that.
Why the length of time for ABC time for projecting? What is this question about?
What does that say? I think in your Q&A you've mentioned that sometimes you'll measure the time from to project.
I'm using the price coverage of wave A to project the price coverage of wave E. I'm using the time difference between C and D to measure the time of E. So that gives us this amount wherever wave D ends. Okay.
Right. Okay. I see what you mean. Yeah.
Okay. So that takes care of all those questions. This chart is no longer any good, right? So I'm gonna go and delete this.
Yeah.
Let me look at Evgeny's stuff real quick. Well, it looks like it's a Bitcoin chart. Let me go ahead and open up the mic to Evgeny. Can you put your mic on mute for a second, and let's just see what he's asking here.
Yes,
yes. First of all, the chart's approaching a little too much complexity. I mean, this is right on the border of 55 monoways. I think it's about 50 or 48 or something like that, because I counted them. So it's getting a little too complicated. You really should start with a 6 monthly chart and go back to the very, is this back to the very beginning of Bitcoin?
No, it's just the last couple of years.
Yeah, okay, so you should go back to the beginning, or if your purpose is to count just the pattern off the high, then, you know, this is probably okay, but it's still a little complicated. But if I were looking at this, should I try to open it instead of doing it in here? It might look a little bit better. Okay, let me see if I can increase the size of that. Okay, now I'm not going to be able to probably draw on this chart very well, but let's see, edit, create. Don't see any drawing tools anywhere. So I'm just going to have to sort of, you know, move my mouse around.
Okay.
I don't think I can actually adjust anything on this chart. How do I get out of this? I'm not sure how to get out of this. Okay, so let me expand it again. So if I were looking at this chart, first thing you notice is right off the bat, the highest, most violent move on the entire chart is this decline here, right? More violent than every rally, larger, you know, right off the bat, you're in a downtrend. That's all you'd have to see, and you know you'd be in a downtrend for a long time, because this is the start of something to correct all of the stuff that happened before, right? So whatever length of time goes to wherever prior low, we're going to go sideways for that amount of time or more. And I think it's probably getting close to achieving that already. I don't know exactly where the low was, but so it's gone sideways for a very long time now. So this would be wave A. And the question would be, you know, where does wave B go? And that gets a little difficult from a channeling standpoint, behavior standpoint. Are we dealing with complex correction? Are we dealing with simple corrections? You'd have to go through all kinds of channeling testing for this pattern, you know, drawing trend lines across this high. Well, this can't be a C wave because the trend line gets broken and the B wave not being much more, I think it's even less than 61. Let's see. The B wave is less than 61, so the C wave would have to make a new low. It didn't. So that means the B wave can't finish here. It can't finish here. It gets very strange and difficult to explain what's going on here. I'm not quite sure just by looking at it. But the only channel that's clean, somewhat clean, would be going across these highs like that. So maybe, does this low break this low? If it does, and it's possible, we may have had a zigzag finish at this low with a missing wave and wave C. So it's possible we'd have a 0B trend line coming down like this. Wave C would be over. This would be an X wave, which is what you have it marked as. So this whole thing would compress to a :3 as you have marked. After the X wave, it's a little strange. The behavior looks very bizarre to me. Doesn't look like a real good contracting triangle, but maybe there was some kind of zigzag and then an X wave, then a contracting triangle, but this is too simple in relation to that to make a lot of sense. Let's see. This clearly is some kind of zigzag, double zigzag, complex correction situation. To me, it looks like a zigzag, an X wave, and then a contracting triangle. Then we get a thrust out of it, but the thrust doesn't look as big as this part, so that's sort of suspicious. There's a lot of really weird stuff going on with this chart, and I'm not sure if it can be explained by looking at a chart this complicated. So I would consider getting a 6-monthly chart and redoing this and going all the way back to the very beginning, as far back as you can go in the history of Bitcoin. And then we could take a look at it again and try to get a little bit better idea. Some of you may get notices from us, know that I'm considering starting a Bitcoin service and replacing the Euro service because it's not that popular. And I think fiat currencies are going to go out of style anyway. There's a tremendous amount of interest in Bitcoin. 99% of every response I got was positive. So it's very likely I'm going to switch over to that over time. But I'm going to have to deal with this weird kind of behavior going on. But whatever this is, it looks like something finished here. So that part of your analysis looks correct. That something ended here. It was way too choppy, and then all of a sudden, wham, it started to spike up. So most likely that was the beginning of some new pattern. That pattern is yet to be retraced 60, let's see. Get my ratio divider out here. It's right at 61% of this low. So most likely this is a corrective rally. I wouldn't call this wave B probably. It more likely could be wave A, unless this is not impulsive, and that's going to have to be determined by looking at longer term charts. This is corrective, then this could be corrective, so this could be wave A, this could be wave B, and then this could be a C wave. This could all be some kind of major contracting triangle where this whole violent move up would be A, this would be B, C, D, E, that kind of thing. That would not be good for Bitcoin, because that would mean the thrust is going to be down and that Bitcoin is going to potentially go
Yeah,
out of
that's actually my count. The B wave is the second wave, the second one.
Yeah, because this all looks corrective. It doesn't look very impulsive in nature. So it is possible we're dealing with a market that could go sideways for a long period of time, but eventually with thrust downward, it might be the demise of cryptocurrencies. Who knows? I don't believe that, but that's what this chart could imply. But we need to go way far back in time, and it has to be a log chart. It has to go back preferably to the very beginning of Bitcoin on a cash basis. And it has to be a 6-monthly chart, or maybe even a 2.5-year chart, to really get the big picture first, and then we have to work our way down before we can arrive at these kind of conclusions. It's very obvious we're dealing with lots of corrections, so that's obvious. It's also obvious the trend is now down because the bigger moves and faster moves are happening down than up. So we're probably going to be going sideways or down for a while. But the very first violent up move that's bigger than previous declines is going to signal whatever this is over, and we're going to start trending up again and probably go back above this high. But there's a lot of unknowns here, and so I can't really tell you if it's correct, but it doesn't look wrong. I don't see any serious mistakes on your chart, but it's very hard to count a lot of this stuff. It just looks like a big mess, technically.
So if I can see that, if I can see that wave C is 61% of wave A,
yeah, that would
is
help
it
a
safe
lot.
to assume that?
Yeah, let me measure that right now. Hold on a second. If you measure from the low of wave B, its C wave is exactly 61% right there. So that is a very strong case building for a contracting triangle going way back. And we'd have to figure out how that contracting triangle fits in with the bigger picture, because that would not be a good sign for Bitcoin long term.
Mm-hmm. Yes,
Okay.
yeah, that's my picture too. Okay, thank you very much, Glenn. Thank you.
Okay. Okay, so let's have some questions that have come in. We might get to see what's happening on my chart. Okay, so I'll take a look at Hamid's chart here in a second. Let me go ahead and close this. Let me go ahead and get rid of this. And Hamid, which chart did you want to open?
Yeah,
the one
it's
from
this one.
Sunday?
The one that you're on.
Okay, are the other ones out of date or?
Yeah, yeah.
Okay, that's not enough detail. That's less than 13 monowaves. So we're dealing with extremely low complexity there.
That came out completely wrong. I was supposed to.
Yeah, that looks like a mess.
Well, apologies. Apologies,
Now,
Glenn.
let me try.
I was
Let me
supposed
try
to
one of the other
get rid of
charts.
the big breaks.
I'm not going to be able to use that. I can tell you that. Okay, let's see. Yeah, when you do the PDF, you should make sure you print it to your own desktop and see how it looks before you send it to me.
Yeah,
That way you know if it's looking good. Okay, it looks like you're coming up with similar kinds of ideas where this whole thing is some kind of corrected decline. The C wave would be a corrected pattern, most likely not an impulsive pattern. It's a little more simplified, but there's still a lot of, it looks very similar to the other chart. I think it almost is exactly the same. This is all corrective action. There's no alternation between these. There's no alternation between the advances or the declines. The violent moves are up until here, and all of a sudden the more violent moves appear to be occurring down. So whatever happened probably ended right here, as you have marked, just like the like Evgeny had marked on his chart. So I suspect that, you know, whatever this is either wave A, or if this is wave A, this is wave B, and this could be wave C, and now we're working on a D wave. So it doesn't look good for a while for Bitcoin at this moment in time. Maybe it's a bad time to start a Bitcoin service, but you know, I have to take a look at the really long-term structure. Someone tells me they have cash data going all the way back to when Bitcoin was $1 or less. So that'll help a lot for me to
it
start
started
to piece.
with 5 cents, didn't it? I had that chart.
You had one back to 5 cents?
Yeah, it was started at 5 cents and then it just blew up from there. Or was it 1 cent or something? And it just blew up
Yeah,
from there.
something like that.
Yeah.
You have some more charts here. Are these Bitcoin too, or there's something else? Looks like they're probably Bitcoin charts.
Bitcoin, yeah.
I don't think they're going to open up because they're a certain type of Excel chart that my system won't open. It doesn't open these XLSX files, so I'm not going to be able to open them. So
that's fine.
So what about your questions here?
Yeah, we can just ignore them. That's fine.
Can you work on resending these two charts, but as a PDF in the future?
Yeah, we'll do. I mean, I did analyze the chart, and I was going to send it to you, and then we were all, me and Evgeny, and you know, had ideas, and we wanted to go through this with you, but I just messed it up. So
okay, well, just send them back as a PDF instead of an Excel file, and we'll go over those next time.
Yeah.
Okay.
Yeah,
let me go ahead and close this and close this. And I'd like to just give you all an idea of what happens in a wave analysis class. For those of you who either are going to take, some of you have already signed up, some of you haven't, but you get an idea of exactly what we do in those classes. It's not all this theoretical stuff and discussions about how patterns should form and how they should behave and all that, but it's actually applying it in real time on real charts. So it, it puts me at super high risk because could be wrong almost any time that I predict something. But here's an example of an S&P situation. You can see here where there was the violent movements down, the slower movements up. This was the C wave elongating in the neutral triangle. And then this E wave was around 61 or 38% of this A wave. I think it was around 30, I can't remember which one, but this was violent down, and then violent down, and this was violent change going up. So all of a sudden it's violent up and then smaller down, trendy, drifting, trendy, then violent down. When corrected for a while, actually the F wave goes right here, and then the G wave finished at the high. And notice after the G wave was over, we finally got a bigger, faster move than all prior corrections for the prior 2-3 years, 2 years of advance. So this was the end of something and the start of something new. And it turned out to be what's called a diametric pattern. In a diametric, You have no overlap sometimes between the B and the D. If it were a triangle, they would have to. In a diametric, they can, but don't have to. Diametrics can trend, and the important element of diametric is you have a lot of similarities in time, not in price, but a lot of similarities in time. If you went through to measure it, I've taken all these measurements off now that was done a long time ago, but if you were to measure the time of most of these waves, like E and G and F and D and C, they're almost all the same amount of time, all around, give or take 5 or 10%. And that's a character trait of a diametric. And a diametric also goes through a contraction and then expansion. And then when it's over, of course, you're going to get a move larger and faster than anything you've seen in a long time. So this is where wave theory is useful. Wave theory is not that useful in the middle of patterns. It's useful as you get to the very end of a trend and everything starts to come together. The structure all falls together. The relationships are there. The channeling is there. And you can start working your way down. As this G wave started to form, I started breaking it down on weekly charts and then eventually to daily charts to try to predict the end of this move. When we got that first violent move down, I knew that something had ended, and it looked like it was a G wave of this diametric, and we started this, hyper violent series of patterns. This C wave is longer than this A wave, and this A wave, this E wave is 61% of the A wave. So we have the same kind of pattern between here and here as we had between here and here, but this one is drifting upward with the C wave unbelievably dramatic, but the pattern is drifting upward. The E wave itself was a contracting triangle. So when it finished, we had to have a move up that was as big and as fast, well, initially as this, but the second test would be as big and as fast as this, which is also a counter trend move of the previous decline. And it achieved both of those things. So it initially violently moved up, exceeding, the move here, and then it moved up enough to achieve the same amount of movement from here to here that started from here to there. And that's when I knew we probably were finished with this X wave and that the trend was going to be up. So then I could take the minimum and maximum targets. The minimum target would be taking this entire D wave and adding it to the E wave low, which puts us way up here. And the secondary, or the more likely choice, you can see this is a light dash line, and the thicker one is 75% of this D wave here. And that was the last move of one lower degree than this A wave rally. This A wave is the same degree as this G wave and E wave and X wave. So this is the next lower degree. This would be 2 lower degrees, so I'm not using that one for the big picture. I want the next lower degree. So this is the next lower degree added to here. There's the maximum, here's the minimum, and we're getting very close to reaching that minimum target. So I think there's a good chance that the S&P is going to probably get close to, let's see, that 3,400. I'm just going to add some fake data here and see where it goes. Yeah, so just below 3,400 would be the ideal target to reach our minimum level, and that should happen in the next, let's see, this is January. So we probably have until early March, halfway through March to achieve it, maybe late February. So another month and a half, give or take, for us to get to this target. And the way it's been going, it might make it, but it should if the count's correct. So this is one example of using, real-time action, taking the structure, using prior structure to project and predict future behavior. As far as the neutral triangle is concerned, you want to channel it across the B and the D wave and have an AE trend line where the C wave breaks beyond it, just like a third wave breaks beyond the 1-5 trend line typically. And so that's the big picture. So what we do for the class is after we look at the big picture like this, we of course would have started on a much larger picture with this scenario, knowing that we're in this complex D wave rally. And then I take that information and I break it down to a 6 monthly chart, and you can see a little more detail in this D wave. It looks like we had symmetrical patterns. Symmetrical patterns are where you have almost all the advances the same and almost all the declines are same, and you have 9 separate segments. So you can see that almost everything's the same here, and that produced one symmetrical, an X wave. Then we had 7 segments where the first and last were bigger and the rest of them were more similar. That produced the diametric that we just talked about on the monthly chart. That's this pattern right here on this chart. So that's this pattern here was the one we just looked at. And then a second X wave, and now we started this, final thrust up. This should be the last part of it because the time of this D wave here should be limited to the maximum time consumed by waves A, B, and C, because A plus B plus C from high to low is 3 waves of the same degree. The D wave should not exceed that amount of time. So it means we have about till the end of this year, maybe early next year, where the D wave should come to an end. And that when that happens, then we should start this, sideways to down, multi-5-year kind of bear market. So we take this scenario, break it down to the monthly charts. The monthly charts indicate that we finished this neutral triangle. We're thrusting out of it. Then I look on weekly charts starting from here and trying to figure out what's going on there. So I think I closed the weekly chart. Let's see. Now I haven't done the wave class in a long time, so the weekly chart might be out of date. Okay, so we've taken that same neutral triangle that we had on the monthly chart here in orange, and there's the contracting triangle there. So here in orange is this huge pattern here, and you see we have the same channeling and all that. Neutral triangle took the big rectangle, took 75% of it, which projects here, and you can see it's almost perfectly achieving the minimum rate of ascent required to reach this target. So that helps to reinforce that the count is correct. Now, this would be a contracting triangle that's ending a pattern. So this is a non-limiting triangle. So the apex point is not necessarily going to produce any, significant reaction. And we peaked, reacted, and we've already made new highs. So it may not produce almost anything to worry about. So that would be an example of a non-limiting triangle where the apex point wasn't that useful. And then the market will just keep going past the, the widest wave of the triangle, which would be this wave here added to this low. So we already did that, and now we're thrusting out of the bigger neutral triangle, which only requires a 75% thrust, and we're well on target for that. I haven't worked down to daily charts in a very long time because the weekly charts are pretty complicated. So that's where it stands right now. As we get closer to this target, then I would employ daily charts. Remember, working with wave patterns is a top-down process if you want to do it well and do it safely and be accurate. So you're starting from the largest time frame, controlling complexity, figuring out what's going on there, forcing that structure into your smaller time frame, zooming in on that smaller time frame to only the relevant structure. So if I go back to, let's see, is it here? So starting with the big picture, then we work our way down by forcing just this last pattern. This is the last pattern that's incomplete on the 2.5-year chart. So that's my focus on the 6 monthly chart, is just that pattern. And then when I go lower than this, I'm going to only focus on the last pattern of this bigger pattern, and that's where the monthly charts start. So we're in that D wave here, and this is toward the end of it. And then when I get to weekly charts, I'm going to be focused mostly on just this thrust structure for here's the big picture, but this is the part I'm focused on because this is already done. There's no reason to pay attention to it anymore. It's pretty much been confirmed. We now need to focus on the thrust and when it's going to finish. And as this gets closer, then I'm going to zoom into daily charts to get closer and closer to predicting hopefully the end of what will be wave A. Let me go through a B wave and a C wave and all that kind of stuff. Let's see, can you please show the third wave? I'm not sure if I'm going to be able to find one, Panchai. That's, like I said, I haven't seen one for years and years. Your X wave is more than 3 times bigger than XBC time was in the book. Okay, Hamid, I'm going to have to open up your mic because I'm not quite knowing which chart you're talking about.
It's in the appendix section in the book where you forecast the stock market to 2060, and it's figure 5.
Get that out. So the very last page or two?
Yes, it's figure 4 or 5.
Okay, yeah, if you read carefully through that section, I think do I project? Maybe I did. Hold on a second. Let me pull up my ratio divider here. Okay, so the time of wave 1 had to be projected backwards, and that was the minimum. My minimum projection. It could have even been bigger, but the X wave, remember, in time is measured from high to low, not necessarily from beginning to end. So you can tolerate a correction if it drifts, as long as it doesn't make new lows. So from high to low, the X wave took almost no time at all. From beginning to end, it took a lot of time, but then you have to decide, are you going to measure it from the beginning to the low of 1929? You're going to measure it to 1949. But remember, time is measured from high to low. So if a pattern drifts, you can always let it take a lot longer than you would allow from high to low. So I'm tolerating it because it never makes any new lows. It just drifts upward. And of course, I don't know how long wave one really was, because I'm having to speculate on where it started. It could have been much bigger than I even plotted on the chart. It could take more time and been even bigger. I was marking the minimum requirement to make everything else make sense.
Right, okay.
Does that make sense?
That makes sense. Just a quick one.
This is the reason why I had to have wave one start at 0.3 or so, because I had to make sure that the peak of wave X was no more than 61% above the top of wave one. And that's how I backwardsly projected where to start it. But that was a price projection more than a time projection. It's almost impossible to know exactly where wave one would have started time-wise, but it would have been, you know, around the founding of America probably, so the 1700s sometime.
Right, okay.
Okay, so anything else about that?
Well, no, this is just another question I had is, if you have a zigzag and C turns out to be 161% of wave A, do you presume we're starting an impulse wave?
No, it depends on what the prior structure is. So you'd have to get it in context. If wave C is 161% wave A, that's perfectly acceptable, but also could be a 1, 2, 3 as long as where it's happening allows for a 1, 2, 3. It has to be in a structural position to allow for it. So you're not going to start a chart from a short period of time and start guessing what everything is. Remember, you want to start from the big picture and you work your way down. And it makes it much easier to know whether you're dealing with corrective patterns or impulsive patterns. So, you know, so if you go to this this 2.5 year chart, you know right away, everything since the low in 2009 is all corrective. You're dealing with a massive corrective rally. So everything's going to be corrective all the way up. Okay, so that's what we're dealing with, nothing but corrections. And it's nothing but corrections when you get to monthly charts, because on the larger charts there's correction. There's just nothing but corrections all over the place, right? Only once we start a downtrend might we start getting impulsive action, because the bigger picture shows us that the down movement is where the trending action is. So if we're going to get any impulsive action that's really visible, it's going to be in the downward direction, not the upward direction. And that's why the market keeps creeping up. It's like this weird, slimy kind of upward crawling stuff, because we're dealing with constant corrective action.
Right, okay. Are you thinking of starting Bitcoin service, forecasting service?
Yeah, I'm seriously thinking about it, because I think there'll be a lot of interest, but I'm after looking at the charts today, I'm a little worried it might be starting it a little bit late. Anyway, we'll see. I'll have to think about it. Okay, well, we run quite a bit past time today. I've answered that question, and Panchai, I don't know if I'm going to be able to find one, because I don't have daily charts anymore going back to that high in the S&P. I can show you what it looks like. If I can pull up a tool to draw, see notes. Can you draw a note? No, you can't draw in notepads. Let's see, maybe I can bring up one of the charts. Let me do it on just one of my own charts. I'm just going to draw it in by hand. Let's see. Let's pull up a monthly chart. Okay, I'm just going to see if I can make a new page. I'm not sure if it'll allow me to draw or not. Let's see. Insert. I'm used to using this version. I always use the Mac version. Okay, there it is. Okay, so if it'll let me draw, terminal, third extension terminal might look something like this. And we make wave 3 a little bit longer. And wave wave 4 would overlap wave 1, and would probably fail. Doesn't have to, but it probably would. It just needs to be shorter than wave 3 and similar to wave 1 or related to wave 1, but it might look something like that. Could even be more extreme. You tend to get extreme alternation in terminal patterns a lot of times. So it might look something like that. Wave 1 might be a little bit shorter, a little bit longer. You just want to make sure that wave 3 is the longest wave by at least a little bit. It can be, very just a small amount longer and still qualify when you're dealing with terminal patterns. You can sort of break the rules with terminals, but you have to have overlap between 2 and 4, alternation sometimes to the extreme. So you might get a situation where wave 2 looks like that, and wave 4 looks like that. So this would be extreme alternation. Very big fourth wave, 90, 95% with very small 2 wave. Third wave is the longest, probably takes the most time. Alternation between 2 and 4 to the extreme. One's time consuming and complicated, and subdivided. One's simple and very small and not subdivided, that kind of thing. Does that answer your question, Pancha? Let me go and unlock your microphone. Give me a second here. Okay, so your mic's unlocked. So does that answer your question?
Yes.
Okay, let me go ahead and undo all that. Okay, it's not going to let me get rid of the sheet. I'll just have to delete it. Okay, well, let's call it a day, and hopefully that gives you all an idea of what the wave theory classes are like, but it's much more detailed, and it's going to be day to day or week to week, where we just follow up with the most recent week's structure and see how it is adhering to expectations or not, and if any changes are required or adjustments. So it's going to involve identifying structure, identifying what the direction of the trend is, projecting movement based on prior evidence, based on prior B waves or the last wave of a previous pattern used to help predict the last corrective wave of a previous pattern used to predict the future move of a new trend. So it's all that, just constantly integrating, going from the largest time frame, working our way down to the smallest time frame, all done. Now, for those of you who are more interested in learning how to trade, because wave theory is mostly only useful at extremes. Like wave theory saved my life in 1987 by not being long the market. It saved my life in 2008 when I knew right in the early month of January of 2008 that we had started this massive bear market and that it was going to be incredibly large and drop below the lows of 2002. The low in 2003 also predicted the end of that and the rally all the way back to the highs. So it's great at extremes and helps you to make a drastic change in your strategy and allows you to comfortably or at least logically fight the crowd, because there's going to be a lot of news at an extreme that's going to try to convince you that what you're thinking is ridiculous. But wave theory can help keep you logically on track and avoid those kinds of disasters. Where you're, long way after the high, or you're short way after a low. But as far as day-to-day trading, when you're toward the middle of patterns, wave theory is not going to be that useful. It might say the trend is up, but you're not going to know how to trade it, how to manage positions, how to manage risk, how to enter positions, potentially have stops, maybe how to trade options, all these kinds of things that are involved with good trading practices, good money management, good risk management. That's not covered, that's not part of wave theory. Wave theory is a predictive technology. So if y'all are interested more in trading and making money, I do offer trading classes that are small groups, generally just 3 or 4 or 5 people, and it goes into actually how to trade markets to make money instead of just predicting them, which only is great at the end of trends, because if you predict at the end of a trend, then you can avoid disaster. But in between the top and the bottom, it's very difficult to trade with wave theory. Anyway, so I don't really swing trade with wave counts, Ray. I have transitioned almost all my trading to river theory, which I've been working on for 20 years and has gotten to be a very sophisticated, highly developed, very logical, objective kind of trading technology that works between the tops and the bottoms of predictable trends. It works much better in that period So wave theory will just help to keep me out of danger at the extremes. The rest of the time I'm using river theory and money management concepts and option strategies to make money trading. Okay, well, I guess that's it. Let's call it a day, and next week we'll go through chapter 12. And if you have any charts, make sure they're PDF charts so I can actually look at them, and we can go through the analysis of any markets that y'all want to look at. Chapter 12 is more the section and has some weird rules like the rule of reversal logic and things like that to help you to put together counts when you're not quite sure what to do. But we'll get into that next time. So y'all have a good week, and I'll talk to y'all in 7 days.